Hare Krishna. Once again, welcome to my channel, Purposeful Prosperity. We are continuing with our wisdom series, and today from Little Book of Common Sense Investing. And today we are trying to go through the most important chapter, which I think every investor have come across, which is about asset allocation between the stock and the bonds. This is chapter 18, where we are going to understand that what should be our asset allocation when we begin to invest, as we accumulate wealth, and when we retire. So, at all the three phases, let's just learn how the asset allocation should be working for a common retail investor. So, Mr. Michael is giving some very good statement where he says that the most important key to successful investing can be summed up in just two words: asset allocation. So, definitely, this is the most important thing. The statement is very powerful. This clearly says that asset allocation is the most important thing and it cannot be ignored. So now when the question comes about asset allocation, so Bogle says that there is no easy answer. Why? Because first of all the investors are different. They have the wide range of investment goals, their risk tolerance are different, and even their behavioral characteristic is also different. And all of them are going to decide major factor among the asset allocation. Second thing is that he says that in terms of US market, we have seen a 35 years of extraordinary return in the stock market and the bond market, which he thinks that unlikely to recur in the coming decades. So definitely there is no guarantee that whatever we have earned in the past, the same returns we are going to earn in the future also. And then the third point where he says that all the authors of books on investing are in a real sense captives of the era that we have experienced. That's very important thing because we have to really understand that most of these investing books have been written in that era of last 35 years where stock market has performed exceptionally well. So if you are writing any books in during that time period, then there is very high chances that you are influenced with the past returns. So all these strategy that is being discussed across all these different books, they can be sometimes whatever they have been discussing might not comes true in future. That is why having a proper asset allocation is very important because future is completely unknown and dark for a retail investor. So let's just see what Benjamin Graham has to say about the asset allocation. So Benjamin Graham believed that your first investment decision should be how to allocate your investment asset. And that means you need to ask two questions that how much should we hold in the stocks and how much in the bond. That's a very important decision and that should be your first decision. Then Graham says that believe that his strategic decision may well be the most important of your investment lifetime. So he's saying that not only this is the first investment decision, but this is the most important investment decision that you are going to make in your lifetime, which is about the asset allocation, that how much you are going to hold in the stocks and how much you are going to hold in the bonds. There is a study done by Princeton where it says that asset allocation is the primary driver of performance comparing comprising 93.6% of returns. So do you see that how our performance of our portfolio is completely depending 94% depending on our asset allocation itself. So definitely asset allocation cannot be ignored. So this study was conducted in 1986 and where it says that market timing can earn you a return of 2% additional return. Your selection of what kind of funds that you have selected, it can add up to 7%. But whatever is your asset allocation, that is going to make between 91 to 94%. So definitely the impact of average portfolio performance, your asset allocation is the one which is a major factor. All others can be very minor compared to the asset allocation. So as per the study, the astonishing 94% of the differences in total returns achieved by institutional managed pension funds. And what this 94% suggests is that long term fund investor profit by concentrating more on the allocation of their investment between stocks and the bonds and less on the what particular fund they are holding. So that's very important. I think as a retail investor, we always think that, okay, let me select the best performing fund for my portfolio. But that's the less important question. The more important question is, and Graham also saying that, in fact, the most important question is that what should be my asset allocation? Because that is what is going to drive the returns that I am going to get in my coming years. Now, Benjamin Graham is suggesting a standard deviation of 50-50. What does it mean? So Benjamin Graham suggests a fundamental guiding rule of investor that uh, a person should be not having less than 25% and more than 75% in the stocks. At the same time, he also says that person should not be holding more than 75% in bonds and less than 35% in bonds. So definitely, so a range is 50-50, but you can extend that range from 25 to 75%. So, a truly conservative investor will be satisfied with the gains shown one half of his portfolio in the rising market. So, definitely, if you have 50-50% portfolio, then definitely half the time you'll be satisfied if the market is rising because your one half is already invested in the market. At the same time, when the markets are falling, you will be really happy or solace because you will be doing much better compared to all other retail investor who have invested 100% the equity. So definitely it's about the risk adjusted return. So the Graham formula is 50-50. That should be the beginning for any retail investor. And we have to also note that when the Graham book was written, which was in 1949, that time the yields on the stock was close to 7% and yield on bonds was 2% around. So there is a difference between 5%. And if you look at the Indian market right now, also the difference between the bond yield and the market return, we also have close to 5% because our Nifty return are close to 12 to 13%, and the bond returns are right now between 7 to 8%. So definitely this 50-50 standard division is going to work for most retail investor. So the general principle Grime announced it all these years ago remains remarkably intact. So that is the beauty of Benjamin Graham. That's why Warren Buffett and Bogle really admire him, because whatever principle he has set, they are going to work irrespective of the time period. Bogle further says that his suggested asset allocation percentage still form a sound starting point for a sensible investment program. So if you really want to become a intelligent investor and starting your journey in the stock market, then this 50-50 is the perfect portfolio for you to start. Bogle says that the Grimes allocation guidelines are reasonable, but he's saying that mine are similar but more flexible. And he says that your because he's going to add another factor into that thing, and that is about the risk tolerance. So where he says that your common stocks position should be as large as your tolerance to take the risk what permits. So Bogle recommend that the highest recommended general target allocation stock would be 80% for a young investor who is in a phase of accumulating wealth for a long period of time. At the same time, the lowest target allocation should be 25%, which is going to apply to older investors who are late in their retirement ages. And why? That's because old investors want to give greater weightage to the short term consequences of their action than to the probability of future returns. So, definitely, if you are in a retirement phase, you're, you are not chasing after return. You are chasing after a market beating return, an inflation beating return, and at the same time, protection of your wealth. That should be the goal for an old investor. And definitely, Bogle is warning that in investing, there are no guarantees. So the basic allocation model which Bogle recommended for the wealth building. So there he says that there are few points that we should be considering, and he says that that's all about common sense. So first of all, he says that investors seeking to accumulate asset by investing regularly can afford to take somewhat more risk. Why? Because investor who has relatively fixed pool of capital and are dependent income or even distribution of their income to meet their day-to-day living expenses. Definitely we have to understand that if you are in accumulating phase and if you are young, definitely you can take more risk, you can put more of the amount into the stocks compared to the bonds. But if you are in a older time frame, definitely if whatever wealth that you have created, it's going to, you need to use them as a regular income also. So definitely you cannot take that much amount of risk. So for young investor with more time to let the magic of compounding work from them can also afford to be more aggressive, while the old investor will likely want to steer a more conservative course. So that's the formula for the wealth creation. Now, for the asset allocation, Bogle is giving mainly two broader categories. So first of all, he talks about the accumulation phase. So, for investor in the accumulation phase of their lives, working to build their wealth, focus on the stocks and bond mix of 80 to 20 for a young investor and 70-30 for an old investor. So, if you are really in a young phase and definitely accumulation phase, if you are more young, I would say I think you just started your job, then 80 to 20% is the ratio for you. And if you have reached to an age where you have got some kind of a responsibility of, you have got married, you have some responsibility of your kids or something, or your family, then definitely you should be reducing a little bit and you should be going with 70 to 30% if your aim is to accumulate wealth. Now, on the right hand side, I have tried to given the historical returns of close to past 95 years, where you can see that there is hardly much difference between a 70-30 or 80 to 80 bond return. But we can see there's a risk tolerance, because the worst year, which was 1931, you can see that in the 80-20, there is a downside of close to 35%, where on the 70-30, the downside was 30%. So it's again up to you to decide how much of downtime or how much of risk, how much negative you can see your portfolio. That is what something is going to decide what kind of a ratio you should be making. But for a accumulation phase, this 80-20 and 70-30 is the recommendation from the Bogle side. Second phase is about the post-retirement accumulation asset allocation, where he says that for investors starting the post-retirement distribution phase, so if you are again young, then the 60 to 40 should be good for you. And if you are an old investor, then definitely you should be sticking with the Benjamin Graham formula, which is 50-50. So on right hand side, I have again given the past historical return of 26 years. So you can see that this is 60-40 or 50-50. The returns are hardly much difference. But if you look at the worst performing year, once again the 50-51 is having just 22.5% drawdown. At the same time, a 60-40 is having 26%, and we have seen that the 80-20 was having close to 36-37%. So definitely, if you are an older investor planning for your retirement, post retirement, in fact, actually, then 50-50 is the way to go. And if you are the young, and then definitely you can go for the 60-40 also. It's again individual's choices, but that's the general recommendation Bogle is trying to give here. So Mr. Weichel further says that an asset allocation plan is based on your personal circumstances, goals, time horizon, and need and willingness to take risk. So all these parameters are going to combine together, and those are all these parameters can be the guidelines for you to set your asset allocation, which is the most important thing. Now Bogle is introducing a term about the risk tolerance. So he says that there are two fundamental factors that determine how much you should allocate your portfolio between stocks and bonds. So first of all, your ability to take risk, and second is your willingness to take risk. So there is a difference between ability to take risk and willingness to take risk. And Bogle explains that this ability to accept risk and your willingness to accept risk constitutes your risk tolerance. So combine these ability to take risk and willingness to take risk is called your risk tolerance. And every retail investor should spend sufficient amount of time to find out his risk tolerance. That's the way, because that is going to form a main framework for you to do your asset allocation. So knowing your risk tolerance is really important. Let's just understand what is this ability to take risk. So here Bogle says that your ability to take risk depend on the combinations of factor, including your financial position, your future liabilities, how many years you have available to fund these liabilities. So all these different factors are going to determine what is your ability to take risk. In general, you are able to accept more risk if these liabilities are relatively far in the future. Definitely, if your goals that you have planned that are really far in the future, let's say 15, 20 years, then definitely you can take more risk. Similarly, you can accumulate more assets related to your liabilities, then also your ability to take risk increases. So, as and when you are going to accumulate more assets, then definitely your ability to take risk also increases. Now, let's just understand what is this willingness to take risk. So, your willingness to take risk, on the other hand, is purely a matter of preference. Some investor can handle the ups and downs in the market without any worry, and there are few which cannot sleep at night because they are frightened about the volatility of your portfolio. So, if you have done asset allocation for your portfolio and with the markets ups and down is going to disturb your sleep, then my dear friends, you have definitely selected a wrong asset allocation for you. You should be changing that immediately. Otherwise, this is going to create major roadblocks in our investment journey, and we are not going to create good amount of wealth based that we are all are looking for. So that's why knowing your risk tolerance is very important. Now, Bogle talks about the four decisions that every intelligent real investor should be making. So, first of all, and the most important, he says that you must make a strategic choice in allocating your assets between stocks and bonds. So, first decision is very clear that you need to have a combinations of stocks and bond. You cannot go with just bond or just stocks. That is not going to work. You have to take a combination, and that's the strategic choice you should be making. Second thing is that he's saying that we need to make a decision to maintain either a fixed ratio or a ratio that varies with the market return. So that's another choice that we should be making. Do you really want to always have a fixed ratio of the stocks bond, or do you want to change that ratio depending on the market condition? So let's say if market is performing really good, then definitely you want to reduce your equity portion. And similarly, if the market is performing really bad, then at that point you might want to increase your equity portion because markets are cheaper at that time. So all these things are going to decide what kind of so that decision is also really important what a regular investor is taking. So on Bogle, on this point, he's saying that this fixed asset, fixed ratio where we periodically rebalancing our original asset allocation is a prudent choice that limit the risk, maybe, and may well be better choice for the most investor. So this fixed ratio is the recommended choice by Bogle for most investor, where you do this periodically rebalancing, and whatever ratio that you have started your investment journey, you are going to return back to the same asset allocation. But at the same time, Bogle also says that this portfolio, which is a portfolio which is never rebalanced, however, is likely to produce higher long-term return. Why? I think we know we all of us, my viewers knows the answer. It's because about the cost. Because whenever you are going to have this rebalancing, you need to pay some taxes in buying and selling. You need to pay some pay the cost of again this buying and selling. So all these costs are going to reduce our wealth. So definitely, if a portfolio is not rebalanced, then definitely it is going to give the higher return. But for a deal investor, he still suggests that going for a fixed ratio and periodically rebalancing is the best way to go. Now, the third decision the Bogle talks about the tactical asset allocation. Uh, so the The introducing of an element of tactical allocation, varying the stock bond ratio as market condition changes. So, as per Bogle, this allocation carries its own risk, and changing the stocks and bond ratio may add some value, or they may not also, because you never know about the future. So, in general, investors should not engage in tactical allocation. So, Boggles clearly advises that if you are a common retail investor, then don't try to go for this complex tactical asset allocation. Stick with a fixed ratio allocation, and that's the way to go. And then the fourth and final decision that comes, and which is, as per Bogle, the most important, is the decision as to whether to focus on actively managed mutual funds or the traditional index one. And I think by all these chapters, he already clearly and convincingly put the sufficient evidence to us that points that the index strategy is the way to go for a common retail investor. Bogle further adds, he says that the low cost portfolio with a lower allocation of stocks and therefore lower risk can earn the same or even higher net return than a portfolio with a far higher allocation of stocks, provided only that the cost of investing in the lower risk alternates are marginally below those in the higher risk alternates. So definitely we understand that cost matters a lot. So if we have to keep our cost really low, then definitely even after having a low percentage in our asset in our stocks, we can still get some same return or even higher return. That's very important. And definitely when Bogle says something, it definitely has to be backed up by the data. So here Bogle is trying to give the data, and he has taken two scenario. One is the high cost active managed mutual funds, which are maintaining a ratio of 75 in the equity and 25 in the bond. And then it is comparing the same with a low cost index fund portfolio, which is maintaining just 25% in the stocks and 75% in the bond. But in these highly active managed mutual funds, there is a huge cost. So although the gross returns are same in both the levels, but due to the cost, if you see the net return, uh, the highly managed actively mutual funds are getting 3.5% at this in comparison to the low cost index fund portfolio, which is giving 3.66%, which has given actually a better return. So you see the cost is really important. So if we are really maintaining our cost at a very low level, then definitely even after getting less in our equity portion, we are still getting some good return. So that's the way to go. So the lower cost enables lower risk portfolio to provide higher returns than higher risk portfolio. So that we already seen with the data. The index fund changes the conventional wisdom about asset allocation. So definitely the as whatever asset allocation wisdom that we have, index funds are again going to play a really important role. If somehow you can use the index fund for both your stocks and the bond, then there is nothing better than that kind of a combination that you use for your asset allocation. So cost matters. I think this is something Bogle has been explaining into each and every chapter. And he says that your risk premium and cost penalties ever at war with each other, we must find their way into the process of rebalancing the stocks and bonds in our portfolio. So when we are doing this rebalancing, we need to always make sure that our costs are minimum and we are taking the risk accordingly. That's the way to go. If we are not taking that balance and not considering the cost, then we are doing a damage to our investment journey. So asset allocation. For asset allocation, now Bogle is trying to give some human perspective. So he says that there is a very little science to establish a precise asset allocation strategy. So definitely it's not a science. That's something we have to understand. So there cannot be a fixed ratio which is going to work for all of us because every person is different. So that's why he added this human perspective here. So allocation need not be precise. They are also about the judgment, hope, fear, risk tolerance. And he also says that there is no bulletproof strategies available for the retail investors. So he in fact says that even I worried about the allocation of my own portfolio Look, such a great investor doing index investing, and then also he's worried. So with that, he is clearly saying that there is no asset allocation, one asset allocation that is going to work for all of us. We have to take all these consideration. Human perspective is very important while making your asset allocation. You should be knowing yourself well, your risk tolerance, your behavioral aspects, everything should be known to you before making your asset allocation. Bogle further says that there are substantial risks, some are known, in fact, some are unknown, which exist in our investment journey. And we are on our own in assessing the probability as well as the consequences. But if we do not invest, we definitely end up with nothing. So, definitely, even after all this risk and everything about the probabilities and all those things, we have to understand that we have to invest. There is no way we cannot invest. If we don't invest, we end up dying poor. And then finally, we all are just human beings operating in a fog of ignorance and relying on our circumstances and our common sense to establish a appropriate asset allocation. So the role of common sense is very important here. It's generally said that we have five senses, but the most important sense is common sense, which is rarely available with most of the people. So we have to use this common sense for establishing a proper asset allocation. At one place, Bogle confesses that I confess that half the time I worried that I have too much iniquities, and the other half the time that I don't have enough iniquities. So you see, this is the kind of a pain every retail investor is going to have. Even Mr. Bogle has that thing. So we have to live with that thing. That minimum level of anxiety should be there. But if you design your asset allocation which is going to suit your behavior and your risk tolerance, then this anxiety can be reduced to a maximum possible level. But definitely it cannot be completely removed because that's the part of volatility is part of equity investing and it cannot be removed. But the one retail investor who is going to make volatility as his friend, he is going to make some good wealth in the market. At the last of the chapter, in fact, Bogle is paraphrasing Churchill's democracy quote, where he says that my investment strategy is the worst strategy ever devised, except for every other strategy that has been tried. So, look, so much of humbleness Bogle is having. So, he, even after putting all the required evidences with data and everything, he still says that my strategy is still uh, can be the worst strategy available. That's why he's saying that do your best, for there is no easy answer to the challenge of asset allocation. So definitely we have to spend some time for investing journey because asset allocation is the most important thing. So we have to give sufficient amount of time to know our risk tolerance, our circumstances, our behavior, and based on that, making an asset allocation that is going to suit us. And we have to definitely make sure that we use our common sense for devising that asset allocation ratio for our investment journey. So another great investor, Mr. Ray Dalio, says that we should have a strategic asset allocation mix that assumes that you don't know what the future is going to be. I think that's one of the common mistake all retail investors are making, where they predict that we know the future. We know this is the past return 15% I've got. In the future next 20 years again I'm going to get those 15 kind of percent of return, and that's how I'm going to get the achieve the results. No, my dear friends, that is not how it works. So such a great investor, Ray Dalio, saying that he himself is saying that we don't know what the future is going to hold. That's why we are taking the strategic asset allocation. So how can a retail investor ignore that thing? Definitely we cannot ignore. Then Mr. Tony is saying that the difference between success and failure is not about which stock you buy or which piece of real estate you buy. It's again asset allocation. The two important words. I think the full stress has been given. This complete chapter is about asset allocation only. There is another quote by Mr. Roger where he says that on average, 90% of the variability of return and 100% of the absolute level of return is explained by asset allocation. See, 90%, 100%. What else you we retail investor want? So definitely, if that high of a particular factor of investing, which is having such a high impact on our returns, how can we ignore that thing? Definitely, we cannot ignore. And I think in this chapter, Bogle has given us a good enough information on how on what basis how we should be doing the asset allocation, whether we are in accumulation phase or whether we are in our retirement phase. So all those things have been clearly explained. I think this one chapter alone, if you go through this video again and again, I think this is going to give you all the answers that you're looking for your asset allocation. There can be no video, at least I am not able to find such a video which is explaining an asset allocation in such a simple way. So thanks to Mr. Bogle for giving us this wise wisdom knowledge by which we can do this asset allocation. So I hope with this knowledge, all my viewers are now know how to do the asset allocation. They understand the importance of asset allocation. They also know that how they should be selecting the asset allocation, especially when they are trying to begin their investment journey, or they are in accumulation phase, or when they move in their retirement age. So all these things are going to decide how you are going to earn your wealth by following a proper asset allocation. So this is chapter is just a first part of asset allocation. There is a second part of asset allocation which is being discussed in chapter 19. I'll be coming very soon with this next chapter, and that is going to cover the asset allocation. I will highly request all my viewers to please go through this video once again if you have time, so that you will be really firmly convinced about the importance of the asset allocation, and at the same time you will understand about the different factors that governs your asset allocation, that empowers your common sense to take the right allotment for your asset allocation in your investment journey. So thank you for staying with me, and I hope you really get something out of this thing. At least I myself have learned a lot about this asset allocation important, and I am going to go and review my own portfolio to see am I following the right allocation. I am going to evaluate my risk tolerance, and I request every one of you to also do the same. If you think this kind of contents are really helping you out, then please feel free to like, share, and subscribe, and make sure that such kind of contents reach to most common retail investors so that they can really become wiseful and intelligent investor, and they can really build wealth in their ascent in their investment journey. So I'll very soon come up with the next chapter. Till then, thank you once again. Hare Krishna.